Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Brianne Gardner is on the show today. She is Senior Wealth Manager at Velocity Investment Partners, Raymond James, and we'll be taking your questions on Canadian and U.S. large caps. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email at marketcall@bnnbloomberg.ca. And we'll bring in Brianne now. It's good to see you. Thanks so much for joining us.
Yeah, thanks for having me as always.
It's been an interesting day so far for the markets, specifically after that Supreme Court ruling. What do you make of what we're seeing today, first of all, just in terms of that kind of reaction?
Yeah, I mean, it's been, as you mentioned, Lindsay, a headline-heavy morning, especially, seeing U.S. GDP that came in well below expectations, really, while inflation remains sticky. So that's painting a picture of slower growth with persistent price pressures out of the U.S. That's really almost the worst combo growth we see, of growth slowing while inflation staying firm. And that's that, stagflation light. Yes, markets initially sold off on the news, but reversed sharply higher after, you mentioned, the Supreme Court struck down the use of that emergency powers to impose those tariffs. So really removing one of the biggest policy overhangs of the past year that we've seen. And that ruling, signals a meaningful shift in the trade policy, and markets are treating it as a net positive for consumers and businesses alike. So I think beneath the surface, if we look underneath it, that really, it remains a market of dispersion, right? Not direction. So nearly a quarter of the S&P 500 is already up or down more than 20% this year in either direction. And we are seeing this leadership continue to rotate away from broad momentum towards earning quality and real economy sectors like energy, infrastructure, and select industrial names. And we are seeing that AI spending is still remaining a major theme, but now investors are really raising the bar on proof that elevated CapEx is translating into sustainable returns.
You just mentioned a couple of sectors there. Are those the ones that you would prefer in this kind of environment that we're seeing right now? What ones you think investors should be looking at, or where do you think investors should be looking?
Yeah, I think our positioning overall still remains constructive and active in this type of environment. We are being patient. We have some cash on the sidelines or some dry powder, and I do like those sectors. We are seeing materials still extremely strong, and we continue to favor that sector. Energy has seen a pickup, especially with some geopolitical risks front and center, and we still, have been taking profits along the way on a lot of our tech names and seeing this broadening out as well. But I do think it's not about necessarily reducing all of our equity exposure, but being more selective in the companies and businesses we hold, right? So we favor high quality companies and earnings that are leaning more onto that commodity exposure in Canada, for sure, and continue adding a lot into our international diversification as well. And I think this is a market that rewards discipline, and to remain nimble, as policy, geopolitical, and earnings are reshaping leadership, we want to make sure that we are positioned correctly for what is coming. So this is exactly why I think staying focused on quality names when pricing power and strong balance sheets right now, companies like Microsoft, even Costco, Royal Bank, businesses that will continue to do well, whether the economy is growing at 1% or 3%. And same thing, gold is having, a moment for a reason. Uncertainty like this is why we've maintained that gold allocation for our portfolios and for clients. We're not making big moves right now. I think it's one data point at a time.
Okay, we're going to take a quick break right now, but we will be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps. Here's how you can reach us. Welcome back to Market Call. Brianne Gardner joining us today, taking your questions on Canada and U.S. large caps. Brianne, we're going to start with an email question from Hillary. This email reads, could I please have your comments on advanced micro devices? So AMD, what do you think about this company right now? Is it in a good place?
Yeah, we have owned AMD multiple times in the portfolio, have traded it Currently, we don't own it right now. Directly, we own NVIDIA, I would say, instead of AMD, which is a little bit more of the dominant player in the AI chips. We also own, some of other big large cap names like Microsoft, Amazon, Google, that those companies really are spending the money on these chips. I think AMD is really trying to become the credible number 2 in the AI chips behind NVIDIA. And their CEO, Lisa, has really called 2026 a very important year for that push. They have the new AI chips ramping out now. The bigger ones are shipping later this year. That's really designed to compete with NVIDIA at a direct level at the data center level, not just the individual chips as well, but full integration system. I think the challenge is that NVIDIA's software ecosystem is that developers are built around NVIDIA's tools. So that will be a struggle for AMD. As a number 2 player in that with improving competitiveness, that is meaningful upside still if the AI spending continues at this pace. I think it's really coming down to an execution story. If the new chips do deliver, that they can crack into this hyperscaler budget alongside NVIDIA, that will be a real upside from here. Right now, fundamentally, the stock ranks an 8 out of a 10 for us, and we are seeing analysts, between a buy and a hold on the street, but still price targets about double-digit upside from here of about 40%. So again, we favor NVIDIA at this time, but I still think if AMD can, stay what they're doing and follow through on that, they could see a nice pop on the stock there.
Okay, we're going to go to the phone lines now. Chris is calling in from Delta, BC with a question. Hi, Chris.
Oh, hi, Lindsay, and good morning, Brianne. Thank you for taking my call. Brianne, I've asked you a few times on Meta. I know, I believe you're quite positive on the name, and I would just like to ask you about your long-term prospects of that. And is Meta, like AMD, one of those companies that you've traded maybe a few times, or is Meta more of a long-term investment? Thank you so much. I'll hang up and listen.
Okay, thanks for your question. Brianne?
Yeah, great question, Chris, and thanks for always asking. I do love Meta. Right now, I would say it is a stock that we can tactically trade as well. If we see these big swings, and we did, see a pullback recently, even in April, and again this year, or again in January, the stock had pulled back. So for us, we saw a great time to be adding to client portfolios. I think we own Meta because it has quietly become one of the biggest beneficiaries, yes, of AI, not on the infrastructure side like NVIDIA that I was mentioning, but on the monetization side through really advertising. So the AI is directly improving ad targeting and engagement. And in their last quarter, we saw their revenue grow about 24% year over year. And that's impressive. That acceleration, which really tells me where these AI investments are already translating into real dollars. And that's what we want to see. What stands out to us is their operating leverage. Even when heavy AI and infrastructure spending and dollars are being spent, operating income is still expected to grow, implying revenue growth north of 20% this year. In our view, I think Meta is more durable business than the market gives it credit for. To be honest, it has one of the strongest advertising platforms globally, improving margins over and over again, multiple AI-driven growth, and we still see more upside for there. And I think that can extend this cycle well beyond the next quarter. So for us, it ranks a 9 out of 10 fundamentally, and we still see upside. Analysts on the street, you're looking at a buy or outperform with, again, around that 35% upside from here.
Okay, thanks for that. We're going to move on to another phone caller. Frank calling in from Toronto with a question. Hi, Frank. What's your question?
Hi, Lindsay. Hi, Brianne. My question is regarding Apollo Management. It's taken a beating the last 3 or 4 months, and I was wondering what she thinks about this sector and whether or not it's a good time to buy into Apollo at this price. Thanks very much.
Okay, thank you. It's a sector as a whole that's taken a bit of a beating recently. Brianne, what do you think?
Yeah, I think, yes, we have seen kind of Apollo, treading underwater for a while. We don't own Apollo in the portfolios for us. And while it's still one of the major players in the private markets, I think we are becoming more cautious at this stage of where we are in the business cycle and the companies that we want to grown through this stage. So yes, the business, continues to grow. We're seeing their fee-related earnings and raising capital in the private credit space, but expectations are elevated, and the stock reflects a lot of that too. I think what's changed, especially this week, is the tone around the sector, right? We did see Blue Owl shares and the industry in general keep dropping after announcing asset sale and change in that fund structure. That's some credit liquidity and valuations about that space. That kind of headline reminds investors that this space can be sensitive when confidence shifts. And, even though they still are have other large peers that weren't directly involved, the pressure shows how quickly sentiment can spill over into those alternative managers. So while I still respect Apollo's platform and scale, I think staying selective here in this environment, we prefer businesses that have less exposure to that credit cycle risk and really more visible earnings during that durability. So that's not a stock we own, one that we're staying away from. You still see some upside between a mix of buy and hold from analysts on the street, but again, not a stock that we own at this time.
Okay, Elizabeth now calling in from Edmonton with a question. Hi, Elizabeth. What's your question?
Good morning. My question is about Canadian Tire. I like the dividend, and they recently reported good results. So what would you think about this stock? And also, is it, when you trade it, is it Canadian Tire.A or is it just Canadian Tire?
Okay, thanks for those questions. So yeah, Canadian Tire, pretty decent fourth quarter earnings. What do you think, Brianne?
Yeah, Canadian Tire, we have certainly owned Canadian Tire in the past. I'm just looking at you guys are looking at the CTC.A, Elizabeth. So again, in the Canadian consumer space, I prefer Dollarama, Northwest Company, for a more defensive profile. That said, this earnings reporting changed the conversation a little bit, right? The stock is trading around that what are we seeing around that 185 after strong quarters, and is roughly, still 15 times normalized earning. So it's not as cheap as it was, but the transformation is showing real results. I'd say, we call it right now a little bit fairly valued here. But we are seeing improved momentum, even from a fundamental score. It's now ranking at 8 out of 10 for us and a value of a 9 out of 10, but has the valuation peaked out a little bit? You're seeing price target upside. It's hitting that target ceiling right now. So it wouldn't be a bad time taking some profits off the table actually for Canadian Tire. But again, they did just report one of their best quarters in years, and earnings per share came in at 4.47, up 38% from a year ago, and really blew past what analysts were expecting by a wide margin. So we saw the same store sales were up 4% across the board, and they called it one of their best holiday seasons in recent memories. And consumers were coming through the door in bigger numbers and buying more. So I think, Sport Chek comparable is also having a moment too. We saw comparable sales up nearly 10% in the quarter. So yes, I think these companies are building, and Canadian Tire are a great example, their loyalty ecosystems as well. The WestJet, Tim Hortons partnerships coming in 2026. And we can see how often Canadian Tire consumers engage with the brands across everyday spending. For us, again, we still prefer more defensive consumer names, but if someone were to own this stock and is wondering whether to hold it, I think this quarter really gave them a reason to stay patient and continue to ride it out a little bit, but not also a bad time to be taking some profits off the table.
Okay, and yeah, it's CTC.A on the Toronto Stock Exchange, so hopefully that answers that as well. Brianne, thanks for that. We will take a quick break now. We'll be back with Brianne Gardner of Velocity Investment Partners, Raymond James, taking your questions on Canadian U.S. large caps right after this. Welcome back. Brianne Gardner joining us today to answer your questions. We're going to go to the inbox right now. We've got an email question from Mike, and it reads, could you tell me your outlook for the TMX group on the Toronto Stock Exchange X? Will AI have a major disruptive effect on the company, or is this just noise? Is this a buying opportunity at these levels? Your thoughts, please. Brianne, what do you think about that? Is it just noise, or, there's that big question about AI right now having a major disruptive effect on a lot of companies?
Yeah, I think TMX Group has pulled back quite a bit, as you can see on the chart there too, and is a little bit cautious. Hasn't hit a support that we're seeing yet overall, but still a stock that we definitely have on our watch list, and one that we actually recently added to. So we do hold exposure to it and have held and traded that a few times through even some meaningful pullbacks as well, from seeing the high of about that $58, and then now it's trading, I think, mid upper 40s. So this brings valuation back to a more reasonable level than almost getting quite stretched as it was. It's not, I would say, cheap in absolute terms, but for a business with kind of competitiveness, moat, recurring revenue, we think the risk reward is improving. Again, we're looking at adding and have added into further weakness rather than kind of trim here. And I think the record results reinforce our conviction in the name. So analysts are pretty dialed on this stock. The stock has regularly hit analyst target consecutively. The street target is looking at $61. So, there's 22% upside potential from here. So for us, TMX is essentially the toll booth for the Canadian capital markets. Obviously, they own the TSX, Montreal Derivatives Exchange, and continue to grow in that space. And every futures contract that moves through the Canadian market generates revenue with them. Just reported record quarter, record year. Q4 revenue was up 16%, and earnings per share grew double digits for the full year, beating analyst expectations across the board. So again, their data business makes up about 40% of the total revenue. We see upside there. IPOs and new listings. It's starting to come back slowly after a couple of years, which could potentially be a meaningful tailwind if markets stay constructive. Again, their company raised their dividend 9% and restarted share buybacks after a strong year, which is great to see. And that tells me that management is confident about where the cash flows are headed. So again, we continue to own it. We liked and added recently, and we like their long-term story. And after seeing this record year with 9% dividend raise, again, I think any further pullback could be a great opportunity to buy this stock.
Okay, good to know. We're going to go to the phone lines now. Shatan in Toronto is calling in with a question. Hi there. What's your question?
Good afternoon, both of you. My question regarding the CVS Health, is it a good entry point? And what is your long-term outlook for CVS Health? Thank you.
Okay, thank you for that question. CVS Health. Brianne?
Yeah, CVS Health, not a stock that we own currently in the portfolio, but you're still seeing about 22% upside from here from analysts. They have a price target around that $95 per share. Has been kind of treading sideways, had a nice, a slight pullback there. But in the healthcare space, we do own names like AbbVie, Merck, TMO, Abbott instead. Businesses, I think I see a little bit more of a cleaner growth drivers and less execution risks. So for us, I mean, CVS looks cheap on the surface, but it's cheap for a reason I see right now at these levels. I would want to be cautious about that until we kind of saw that full turnaround. 5 years, yes, you're getting that 11%, but it's nothing I think to write home about and to be kind of bragging about there. And I think compared to the drug makers and some of the device companies, other companies out there, CVS has more moving parts and less visibility quarter to quarter. As I mentioned, yes, analysts see upside because the stock has fallen a lot, but they've been early on this one before. So I would say, caution is a little bit warranted. I think picture they can work. Management stabilizes insurance business and proves the healthcare services strategies can deliver a steady growth. We could see positive momentum from CVS, but I think until then, we'd rather own higher quality healthcare names that we have and revisit CVS. We see their execution improve and confidence comes back.
All right, we're going to go to another caller now. Bernie's calling in from Toronto with a question. Hi, Bernie.
Good afternoon, Brianne. Lindsay. I was wondering, I was going to take some profits off the table and put it into Go Easy. Is it a good time now to get into Go Easy, or should I just stay the course with what I have now? Thank you. I'll hang up and listen.
Thank you very much. We had a question about Go Easy yesterday as well. What do you think about this company, Brianne?
Yeah, I think Go Easy is a stock that we've watched for a while. I mean, even over the past year, has been kind of a downward trend, peaked out in, kind of September 2025. For me, until I see kind of conviction of a turnaround, I would want to just stay away from it at this time. Doesn't mean that we can't see a change up in Go Easy. And again, we have owned it in the past, and I like the business. I like the company, kind of in that non-prime leasing and lending services. But I would want to see a turnaround in Go Easy before I'm adding in there. So for us, not a stock that we own, and want to continue to make sure that we are staying in those profitable companies that we mentioned about before. Analysts, though, you are seeing a attractive value score, right? Because of the sell-off, you're looking at about a 10 out of 10 from a value upside potential. You've seen price target on the street about that 195. Mixed reviews, though, between the hold and buy. Price target upside, again, quite aggressive, 65% from here. But, there needs to be a strong support and a conviction of a turnaround. If I start to see Go Easy, start to see a recover, then I would look at adding or potentially adding it back on our watch list. But I would want to wait until I see that strong conviction before buying this stock.
All right, Pooja now calling in from Oakville, Ontario with a question. Hi there, what's your question?
Hi, good afternoon, ladies. Brianne, appreciate you taking the question on Air Canada. Air Canada I've had this stock for over a year. Do you think with this new ruling out from Supreme Court, it'll open the traffic between Canada and U.S. and create some positive momentum for Air Canada stock? Appreciate your insights. Thanks.
That's a good question. Brianne?
Yeah, and sorry, it was a little quiet on some of that.
It was basically with the new Supreme Court ruling, maybe easing some tensions between Canada and U.S. Will that give Air Canada more opportunities?
Yeah, I mean, I don't own Air Canada, and I think, airline stocks have been hit quite a bit. I mean, oil prices as well and energy there impacting, but it's definitely on our watch list. I think because operationally, the company has made real progress even since the pandemic, right? I think demand still remains solid on travel, particularly on international routes, and execution has improved. Their balance sheet, too, if I'm looking at the numbers, right, is healthier than it was a few years ago, and liquidity is stable, which reduces near-term financial risk compared to the immediate, post-COVID period. Where we're more cautious is on capacity growth. I think the company is planning and meaningfully, they said, into 2027. And in a cyclical industry like airlines, adding too much supply can pressure ticket pricing if demand cools. So costs are also moving higher in the near term, particularly labor, fleet-related expenses, which means margins need strong demand just to hold steady. But while we respect operational turnaround, airlines remain, I think, highly sensitive to economic conditions. So for now, I'd say, I'm watching the demand trends and pricing discipline closely before considering a move from, on our watch list to adding the portfolio.
Okay, we're going to take another quick break right now, but when we return, we will take a look at some of Brianne's past picks. That's coming up right after this. Welcome back. Time now for Brianne Gardner's past picks. These are from August 25th, 2025. Brianne, we'll start with the first one, obviously, and that is IBM. So recommended at $239.43, now at more than $255. Total return of 8%. Are you still holding IBM?
Yep. And, we continue to like IBM. And I think it quietly runs the technology behind many of the world's most essential services, right? From banking, aviation, to government and healthcare. Even with this pullback, I see it as an opportunity. We see as sentimental shift in tech where fundamentals remain strong. We view it as an attractive entry point to add or pick up this stock if you don't own it. I think the core story for this company is hybrid cloud and AI. So as IBM helps companies modernize old systems and connect them with cloud and AI tools, which is becoming essential as companies upgrade technology with disrupting operations. A big differentiator is consulting. Since IBM doesn't just sell software, but also helps companies implement it, that creates a deeper relationship, which again is highly recurring revenue. So they still are emerging in as a leader in quantum computing, where quantum systems work alongside traditional supercomputers. Early tests show that this hybrid has done approach can solve complex systems 100 times faster. So again, we see it as a steady compounder with defensive qualities, reoccurring revenue, and long-term innovation drivers, which is why we still maintain holding it through even some of this volatility. We're seeing a 1 year, 3 year, and 5 year earnings growth annualized double digit, 1 year about 74%, and see about 28% upside from here.
Okay, your next pick was a cloud-based software company, Salesforce, so recommended at $247.87. It's now at $188.04. So this one didn't do quite as well. What do you think about Salesforce now? Are you still holding this company?
Yeah, we haven't seen, I think, since August, it's been about 6-7 months. We still like Salesforce. I still want to give it some time to run. And a lot of the elite businesses are finally getting back to attractive valuation. And that's particularly true for the software space and software market, which is trading at its lowest valuation in a decade. So, those are names like even Microsoft, Salesforce, Oracle are all trading below their 200-day moving average. So for us, that is looking at where we can see opportunities, and we continue to see it in Salesforce, which is the world's leading consumer relationship CRM platform. Again, I think helping more than 150,000 companies rely on Salesforce every day, from small businesses to global enterprising, giving them really that enormous scale. With this pullback we've seen in the stock, and broader enterprise software concerns and some AI disruption fears, I think that these fears are a little bit overstated. Salesforce is embedding AI into its platform rather than being replaced by it, which is innovation. From our perspective, that weakness looks more like sentiment than fundamentals. And I think as Salesforce continues to see the strong demand for AI and data tools, which help customers automate their tasks, improve productivity, generate faster returns on the technology spending, I think Salesforce will see a turnaround story this year. Financially, the business remains very strong with over $2 billion in free cash flow generated last quarter, again, reinforcing their ability to continue to invest that return of capital to shareholders and compounding its value over time. So we actually see over 70% upside from here in this stock. Yes, it has had a pullback, but again, we see this more of a contrarian play maybe to some people, but you're going to start to see the software sector pick up.
Okay, last past pick that is Brookfield Infrastructure, so recommended at $42.69, now at $52, total return of 25%. You still like this one?
Yeah, Brookfield, continues to own those essential assets that people and businesses rely on every day, right? Utilities, pipelines, ports, rails, data infrastructure, really the backbone that keeps the global economy moving forward. And that makes their business essentially attractive if it focuses on stable long-term cash flow, with most assets operating under long-term contracts, creating predictable income and strong downside protection, especially in some of this uncertainty that is floating around the markets right now. We think this stock will continue to do well. Growth is really being driven by electrification, data centers, their global trade. And we saw this quarter expanding its data center power platform to about 230 megawatts. That supports these hyperscalers, again, in the portfolio squarely in the AI and cloud build out. They have capital recycling as another key strength, of a record $3.1 billion in asset sale proceeds generated last year. And on top of that, income continues to rise. We have seen the company just increase their dividend by around 6% for the 17th consecutive year. And again, that to me is reinforcing Brookfield as a rare mix of not just stability, growth, but also income for long-term investors. We see about 15% upside from here still. And again, a stock we want to continue to hold in the portfolio for our clients.
Okay, thanks for that. We're going to take another quick break, but we will be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps right after this. Stay with us. Welcome back to Market Call. Brianne Gardner joining us this hour, and we're going to go to the inbox because we've got an email from Robert in London, Ontario, and it reads, "Good morning. May I ask Brianne to please comment on the FFH fiscal 2025 earnings report last night, the best in its corporate history? Does Brianne have a price target for the stock over the next few years?" So that's Fairfax Financial. Brianne, what do you think about earnings report and the outlook for the company?
Yeah, we don't own Fairfax yet. We own Sun Life, I think, in that insurance space instead, for example. But we are certainly watching Fairfax closely, and the 2025 results have us definitely more interested than we have been in a while. I think we saw at roughly, 1.8 times book value after its best year ever. It's not really deep value, but for a compounder of this quality, that's not an unreasonable price to pay. We'd be more inclined to add on any weakness than chase its current levels. Analysts have a target, I think 3,937, so about 26% potential upside from here. But, that's quite still a lot of room to run. But I think it has never, looking at past analysts' targets, it has never hit their targets once in the last 5 years. So for me, that I'd take that as a little bit of a grain of salt. Can they hit that 6% upside? Time will tell. I think likely we'd see a decent return. But again, I think unlikely to be one of the best in the sector. They just reported, again, going back to their earnings, their best year in history. Net earnings of about $4.8 billion in 2025, up 23%. And that's with every major insurance segment running profitable in the same time. Again, book value grew over 20% for the year. Their core insurance business produced a combined ratio of 93%. Again, meaning they're collecting more in premiums than they're paying out, and they still get to invest the rest. And that's a very healthy operating, firing on all cylinders. So again, one of the things that we're watching is the new deal to take real estate company Kennedy Wilson private. Fairfax is committed to a $1.65 billion, which is a meaningful capital going into a sector that still has some headwinds. So that is something that we are watching. It's not a traditional insurer like Sun Life. It's closer to an insurance company plus an investment vehicle, which makes earnings a little bit lumpier and harder to predict quarter to quarter. But again, after this, beat, it's definitely on our radar.
Okay, Matt now calling in from Kamloops, BC with a question. Hi, Matt.
Yeah, hi, good morning. First time caller here. I was just wondering if you could let me know what your thoughts are on starting a position with Waste Connections for a long-term hold.
Okay, thanks for your question. Thanks for calling in. What do you think, Brianne, about Waste Connections?
Yeah, thanks for the call, Matt. We don't own Waste Connections today, but we have in the past as well. I think, in fact, we've actually first bought it in early COVID and did very well on that position. Our exposure to waste sector comes through some U.S. names a little bit more broadly, but Waste Connections is certainly, a premium name in the space. I say best-in-class margins, disciplined management, and a track record that's hard to argue with, to be honest. Trading around that 162 with analysts average target near 204. There's certainly still meaningful upside here that is being priced in, but a roughly 30 times earnings from a value perspective, you're definitely paying for quality. We call it right now, I'd say fairly valued to slightly expensive. Interesting on a pullback for sure, but not a name we'd chase at this time. Again, you're looking at, potentially 20% plus on the upside. So they just closed out 2025 with their industry-leading profit margins, 33% growth on their core business, which is good to see. Free cash flow is the real story too for Waste Connections. $1.26 billion in 2025, and they're guiding for double-digit growth to as much as $1.45 billion in 2026. 2026. They raised their dividend by 11% last fall and bought over $500 million in share buybacks. So again, big picture is one of the rare businesses that grow quietly. Not a bad time, Matt, to be taking a position or looking at it. Fundamentally ranks at 8 out of 10 for us. Again, as a long-term holder, I think you could see that 20% upside.
Okay, good to know. Thanks for that. And now we're going to go back to the phone line. Steve in Brampton, Ontario is calling in with a question. Hi, Steve.
Hi there. Thank you for taking my call. My question is about Google, especially after the first earnings report and the first quarter in 2026, and then the company commenting on some AI expenditure. The stock tumbled about 14-15%. And what's your take on this from this moment onwards? Thank you.
Thanks for your question. Yeah, the stock did take a hit after that. It's bouncing back today, at least. Brianne, what do you think?
Yeah, we own Google Alphabet and have held it for a while. I would say it's one of our highest conviction tech positions and one that we've been rewarded for staying patient with. So even with that slight pullback, as you mentioned, the stock has had a massive run, but, yes, pulled back after those Q4 results on really concerns about spending, which we view as an opportunity rather than a problem. I think at roughly 22 times, 23 times forward earnings for a business growing revenue at 18% and generating over $160 billion in cash flow annually, we think it's still reasonably priced for what you're getting. We are not trimming here. Analyst targets have skyrocketed over the last year, and while the stock has done well, we expect it to keep leading. 15 to 20% upside from here would not be a surprise, especially after that recent pullback. So again, I still think that it's one of the few companies in the world that leads in search, cloud, AI infrastructure, digital advertising, and streaming all at the same time. And 2025 proved that those businesses are accelerating together, not trading off against each other. I think the spending ramp up is certainly big, but so is the opportunity. And we've seen this movie before with Google. The investments tend to pay off. So we own it, we like it, and any weakness would be a reason to add for us.
Okay, thanks for that. We're going to take another quick break. We'll be back with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on Canadian and U.S. large caps after this. Stay with us. Welcome back to Market Call. Brianne Gardner joining us once again. We're going to go to the phone lines. Pavi in Calgary is calling in with a question. Hi there. What's your question?
Hi, good morning. I want to know your thoughts on Boeing for the long term. I will hang up and listen. Thank you very much.
Thank you very much. Brianne, what do you think about Boeing?
Yeah, thanks, Javi, for the question. I don't own Boeing. I think the company is clearly making progress, though, but it's still a little bit in recovery mode for me. I think we prefer to see a longer track record of consistent execution. The good news, though, is its deliveries are picking up, and that is favorable to see. Again, Boeing has delivered about 600 planes last year, its best level since 2018, and the order book is massive, which shows airlines still need aircrafts. Cash flows have finally turned positive, which is also an important milestone. That tells us that the business is stabilizing after several very difficult years. That said, though, we do see this as a complex business. Production, ramps, regulatory approvals, supply chain issues can create bumps along the way, and we've seen how quickly things can change in their industry. So while the long-term demand for planes is clearly there, we're staying patient. We'd rather see steady execution and fewer surprises before considering adding Boeing to the portfolio. From a value score, ranks a 2 out of 10 for us, and again, not a stock that we own in the portfolio.
Okay, another caller, Anna, is calling in from Toronto with a question. Hi, Anna.
Hi, Brianne, may I have your opinion on Propel? Is it a buy, sell, or hold? Thank you.
Thank you. Brianne, it's had quite the year. What do you think about Propel Holdings at this point?
Yeah, we don't own Propel either, more on the smaller FinCap name that's kind of outside our typical almost quality universe. But I think Propel is still one of the fastest growing FinTech on the TSX. They can do online lending to consumers who can't easily get credit from the big banks. So the growth numbers still, for this company are impressive. Revenue's up 30%, earnings are up 40%. Yes, company has had quite a bit of a pullback, you can see over the past 5 years, looking at that long-term chart. But again, they just bumped dividend headed into this next report. But I think what's important to understand is that what you're buying here, this is lending to people whose lower credit scores, which means or works great in a good economy. But if we see a downturn or weak economic data, which we are starting to see, that loan book can get hit hard. Delinquencies can, and have started to tick up modestly though management says they're still within their targets. To me, that's a cautionary tell, and still a relatively small, less liquid stock. So for me, it can move sharply on any earnings surprise either way, and is a compelling growth story if you're comfortable with that risk profile. But the economics are still strong right now, but it's not a set it and forget it name by any means. You have seen swings in either direction for this name, a little too volatile for me. And I think still you need to watch the credit quality every single quarter. If the economy is softening, which we are seeing those signs, this is one of the first places and one of the first companies that will feel it.
All right, we're going to take another quick break right now. When we return, though, we'll take a look at some of Brianne's new top picks. Stay with us. Join us Monday on Market Call. Jerome Haas will be on the show. He's portfolio manager at Lightwater Partners, and he'll be taking your questions on Canadian stocks. And Brianne Gardner joining us today. Time now for Brianne's top pick. So ATS Corporation, trading on the TSX. Why do you like this one?
Yeah, I see ATS as still remaining one of the most compelling automation platforms in the market. So really benefiting directly from the structural shift towards reshoring, labor scarcity, and the modernization of global manufacturing. Companies across life science, EVs, food and beverages, and industrial technology that continues to accelerate really that capital spending on the automation to improve throughout reliability and cost efficiency. So they are positioned at a high value end of this trend, and with high engineered customization systems, robotics, vision, analytics, and really precision. I think that its project pipeline remains healthy. Margins are improving as scale growth. The recent price momentum reflects the business resilience in even volatile periods. I see further upside as production shifts really from that North American to Europe, and positioning ATS to benefit from the multi-year sector tailwinds. They offer mega cap tech stuff that they cannot, right? Exposure to the real economy, modernization, strong execution, and really owned industrial growth and engine. So we see about 10% still upside from here, and strong price target around that $49.50.
Okay, next up is Energy. Why is this one of your top picks?
Yeah, I mean, energy has been starting to be in favor recently, and I was, talking about energy in Q4. I think we like this name because it provides exposure to rising U.S. power demand. Even especially tied to the data centers and AI. Energy is one of the largest competitive power producers in the U.S., supplying electricity to millions of homes and businesses while also owning its generational fleet. So for us, they did the LS Power acquisition, and still becomes more generational heavy, meaning it is benefiting more directly if power prices stay firm. It's tight supply market. The last quarter was solid. Earnings coming in stronger than expected, showing the business is operating in a well environment. The key growth driver is their data centers. They now have about 445 megawatts, and that is a huge demand that we are seeing. In our view, NRG is evolving from a traditional power retailer into more of a structural growth story tied to long-term electricity shortages. We see about 21% upside from here, with a price target of about $211.
And lastly, a lot of stories going on with this company, and that is Netflix.
Yeah, Netflix, I'd say a little bit more of a contrarian play. There's been a lot of noise around this stock, and we believe the timing right now is attractive for investors as Netflix continues to strengthen its competitive positioning. So while the streaming landscape is competitive, Netflix remains the only platform with true global distribution. So industry-leading engagement, consistent content performance, sustainable positive free cash flow. Yes, we have seen quite a bit of a pullback blowback, but I see that as an opportunity. I think their password sharing crackdown really improved their monetization, and their ad-supported tier is gaining traction. Subscriber trends remain solid. Expansion into live events, sport, gaming, local language has hit. We think strategically that the Warner deal makes sense.
Okay, Brianne, I'm going to have to cut you off. I apologize. We are so out of time. Thank you so much for joining us today, and thank you for watching Market Call. We will see you next time.